Hello everyone. Welcome back to Fundrise Finance. The market has been in a seesaw mode for the past few days. When we look at the S&P 500 component on March 1st, we see almost red across the board with almost all the large caps trading more than 1% below. We have the Russia-Ukraine war situation and also questions around the Fed increasing the interest rate hikes later this month. So understandably, market does not like uncertainty and started the month in a downward move. What we see on March 2nd is a complete reversal. Almost every company in the S&P 500 was up. And today we see a mixed bag picture. But one thing that has remained consistent over the past year, or in fact from the beginning of this year, has been the rise in oil prices. When you look at the performance of oil prices in the last year, they have risen almost 70%, and year to date, oil prices have risen almost 44%. This is impacting the gas prices at the pump. They are currently at their highest in over 7 years, and the price surge has not let down. The national average for a gallon of gas is $3.6, and this rally does not seem to stop. So, as per this article in Reuters, analysts say the oil rally will continue in 2022 also as demand outstrips supply. Though the situation is burning a hole in our pocket at the gas pump, as an investor, we can use this to our benefit and invest in a smart way. Let us look at four ETFs in the energy space that one can benefit from. The first one we have is XLE, the Energy Select Sector Spider Fund from State Street. XLE tracks a market cap weighted index of US energy companies in the S&P 500. When we look at the S&P 500, energy sector comprises of 3.7%. This energy sector has 21 constituents. So XLE considers these 21 companies and ranks them on market cap and invests accordingly. It has an expense ratio of 0.1%. Like I said, it has 21 holdings and it has a yield of 3.31%. When you look at the top 10 components, what we see here is top two, which are ExxonMobil and Chevron, are almost 44% of the entire holding setup. So it is very top heavy, with the top 10 comprising of almost three-fourths of the ETF at 76%. Next one we have VDE, the Vanguard Energy ETF. VDE has 102 holdings because it follows the MSCI USA IMI Energy Index, which has 105 components. It has an expense ratio of 0.1% and it has a yield of 3.24%. VDE also follows the market cap weighting logic. So that's the reason why you will see here the top two components again are ExxonMobil and Chevron Corp, which are almost 38%. The top 10 make up almost 68% of the ETF holdings. So though it has 105 holdings, the top 10 take up a majority part of it, while the remaining 95 are just constituting around 33%. Another ETF which follows the same index of MSCI is FENY from Fidelity. It has an expense ratio of 0.08% and it has a yield of 2.83% with 104 holdings. Even this ETF follows the market weight cap logic, just like VDE, and the top 10 is same as that of 67%. So again, it's a very top heavy ETF with the top two of ExxonMobil and Chevron taking up 38%. The fourth ETF is RYE from Invesco. RYE is similar to XLE, but it tracks an equal weighted index of the S&P 500 energy companies. So all the companies are given equal weightage. It has a slightly higher expense ratio of 0.4% and the distribution yield is 1.85%. As the RAI provides equal weight to all the holdings, we see here the top 10 holdings are like 50% of it. We see all the 20 companies getting equal. We see all the 20 companies getting almost equally weighted. So no one company dominates the entire ETF. When we look at the performance of all these ETFs, year to date, almost every one is in a similar range of 26 to 27%. Over the last year, also a similar performance in the mid 40s. For the last 5 years, we see that RAI has given the highest output of 8.28% and Fidelity giving the least at 1.85%. So, what are my thoughts on the best ETF among these four? The huge rally that we are currently seeing in the energy companies is very unusual. It is mostly due to the Russia-Ukraine war situation and also due to the supply demand dynamics that were hugely impacted by the pandemic. When you look at the yearly performance of how the energy companies have done, we see the performance in the past really has not been that great. Starting from 2014 onwards, we see them giving a negative performance, and then 2016 they go high, 2017 and 18 they are low, from 2019 again they slightly creep up. In 2020, we had a massive drop because everyone was like working from home, traveling less, so the oil prices literally fell down. And in 2021 is when we actually see the prices going up. So if one were to invest into ETFs like XLE, VDE, or FENY, whose majority of the investment is into the top two holdings of ExxonMobil and Chevron, I don't see that's going to be viable going forward. Because if these two companies underperform, the whole ETF's performance will get impacted. But with an ETF like RAI, wherein each holding gets an equal weight, a dip in performance of one company does not have such a large impact overall. And the performance of this ETF has been very good compared to the others over different time frames, be it 5 years or 1 year or year to date or last 6 months. Also, RAI has the highest 5 year dividend growth rate among the four ETFs. So RAI would be my ETF choice to invest in the energy sector. I'm not a financial expert, and all the opinions on this channel are just for educational and informational purposes only. Everyone should do their own due diligence before investing their hard-earned money. If you like this video, please click on the like and subscribe button so that you can be informed of all such informative videos in the future. And also, please leave a comment what such ETF comparisons you would like to see in the future videos. Thanks for watching. See you in the next video. Until then, let's try as much as we can to be financially healthy.